Our cardinal lesson today is about the sequence of returns risk. And what this is simply saying is if it's the order and the timing of poor market returns. Poor market returns or a bad year historically it's going to happen. We don't know when it's going to happen, and we don't know the amount of it, and we don't know that it's not going to happen 2 years in a row. And when we do financial plans, we have to use an average return to do our projections. And so that makes things look like the market just kind of goes up every year by a nice, clean, little, neat little amount. And so the sequence of returns risk is really the risk here is that you would have these bad returns that are coming early in your retirement sequence. And then it also, when you're in retirement and early you have these bad returns, you're also withdrawing money out of your IRA or 401k to live off of. So you got that going against you or against the balance in your account. So I want to bring Tom on, and he's going to illustrate this point and really talk about why we're going over this today.
Yeah, I mean, I think this, if you do not understand this risk, which a lot of people don't, you could be in for a surprise when you enter into retirement. And so I'll go through an example and I'll show you what I mean by that. But something I hear often with clients coming in that generally have done well saving, they've been disciplined in their investing, they haven't been buying and selling and trying to time the markets. And they say, you know what, I've been through market corrections before. The market always comes up. I just don't touch my money. It's going to be fine. Which, when you're saving and you're in the accumulation phase of your life while you're still working, that's absolutely true. And I'll show that here in a second. When you get to the distribution phase, when you have to start pulling money out, then the math changes pretty significantly. So let's get into the show notes and get through an example here. You can find these show notes. They're at the link below on the video. They're also on our website. And we're going to spend a little more time in the show notes today because I think it does a very good job here. And so we're going to scroll past. I'll come back to this page. But let's walk through an example here. So let me see if I can make this a little bit bigger here. What we have are two examples of sort of two hypothetical investors. They each start with $100,000 to invest. At age 40, they have 100,000. They put it in the market and they leave it alone. What we have is two sequence of returns, and these are the average or the annual returns here. If you study it, you'll notice they're just flipped, right? 2%, then 26%, 15%. On the right side, we have 2%, 26, 15%. They're literally just flipped. Is when you do the average, it comes out to an average return of 8% in both scenarios. And you'll notice that the balance at the end of this period of time, when they're right at the end of 64, is 693,824 in both scenarios. Now, how you got there looks a lot different, right? Investor one had a much higher balance, took a big loss early on, but investor two had a big loss early on and then had the better returns later on. The ending number is exactly the same. And that really speaks to that thought where if the market's going up, it's going down, I just leave it invested, I don't touch it. It doesn't really matter when the negative returns or positive returns happen. The ending balance is exactly the same. So this is sort of the accumulation phase of your retirement or of your life. This is before you retire. The next page is where things get interesting. This is now you are retiring. You're 65. You take the same balance at 693 and you retire. And you start pulling out $35,000 out of the account in both scenarios. So all of these things are identical. We have the same return sequence that we did on the previous page, average annual return of 8%, like you did in the accumulation phase, and we've just reversed them, again, like we did on the previous page. Investor one, we have strong returns early on and then negative returns late, and we end up with a balance at 89 of $2.7 million. Investor two, same starting balance, same average return, same money coming out, 35,000, except the negative returns happen early on. We run out of money at age 85. And you can notice the difference between these two is very significant. And so when you retire and you have to start pulling money out, it very much, relies upon not having those really big negative returns in your early years of retirement or doing something to mitigate this risk, because this could be very detrimental to your overall retirement. Let me go back up to sort of the page we skipped over here. this is sort of what the S&P 500 has looked like over time. And you can notice, you look at this chart just at first glance, it's going up pretty steady, right? It's kind of bumpy along the way. We have some pretty big downturns here. This is 2000, 2008, 2022. I mean, there's years where it's down, but on average, as we're going up and just up and up and up. But if you retired, say right at this point, and I'll see if I'll make that even bigger. Say you retired right at this peak and you start living off your money, you have this big downturn right then. That could be, you could not have the retirement that you're planning on doing so. And so what I think we just spend the next part of the show, and we'll bring Hans back on with the board, is really talking about, now that we've identified this risk, we know it's a problem, we know it could be a significant problem. What are things that we do from a planning standpoint to mitigate this risk for your plan?
Okay. So just about everybody that comes into us that we do planning for that needs income from their IRA, 401k, or from their investments, they need to generate money to live off of. We're thinking about this sequence of returns risk when we start recommending where they're going to pull their money from, looking at their taxes, looking at their long term. We have concerns about them running out of money late in life, and this sequence of returns risk. So we want to explain this to people, but we're thinking about it from day one. And some of the ways we deal with this is, one is delaying Social Security to a later date. And you might say, well, that's going to make you have to take out more out of the IRA earlier. Well, it is, but we have a guaranteed return built in to this delay of Social Security. So we're prepared for the future. So just trust me on that one, is that delaying Social Security actually helps us mitigate poor returns early in retirement. The second one is we use some fixed rate returns. So we're going to get a portion of your investment portfolio. We're going to put in something that we have a known fixed rate. And fortunately, we now have the multi-year guaranteed annuities, or MIGAs, that are over 5% that they will guarantee for several years. So that's become a very attractive place to just have a known return where we're not going to have any downside risk on that part of the money for a few years. We're going to talk about using some lifetime income annuities. So again, they have a fixed rate of return and they offer a guarantee of a payment for lifetime. So that takes the poor market returns early in your retirement off the table because the money's in an annuity and it's all guaranteed. And then some fixed indexed annuities with income riders on it that are going to do the same thing here as number three. And our goal is to get your income locked in where you're not affected by this, and you can count on it by using a mixture of guaranteed products. And then once we have your income guaranteed, it's going to leave us a pool of money, or leave you a pool of money that we can invest now in equities, and we can afford to bear this risk because it may not happen. And we can enjoy on that piece of money, we can enjoy putting some of the money at risk. So I want to bring Tom back on. I want him to kind of summarize these actions.
Yeah, I mean, I think the whole idea when we're approaching this from a planning standpoint is we want to get your income secure where it's not subject to the market fluctuations. Because if we can do that, if we can get your basic income needs met via Social Security, maybe you have a pension, use of different types of annuities, and everyone's mixture is different. But if we can do that, that leaves you the remaining pot of money that's not tied up in these other things, that you can act like you were during your accumulation phase, right? You can invest the money. It doesn't really matter when the negative returns happen. It might not feel great, but if you can stay disciplined, you can weather the storms up and down. And now you're just looking at the average annual return over time versus any individual year. So our goal is to use fixed products. Some people prefer just to leave it in cash and live off the cash over that time. There's better ways to do it than that. But again, we can talk about that in your specific situation. The goal is to really get you to a point where your income is not driven by the market performance. And if you can do that, that allows you to stay disciplined, keep invested, not have to wake up each morning and worry, is my paycheck this month really going to be hurt because of what the market's doing? And I think it's just a much better way to enjoy retirement, not ignoring the market. There's some reasons you need to stay invested, but really having your basic needs met by fixed income, I think, is a wonderful way to enter into retirement.
Okay, so we're going to go over, we have the 7 worries or the 7 subjects. And today we've touched on 401k IRA, which is where a lot of retirees have a significant amount of their money. We've touched on income, and we talked about taxes. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening to us.
Thank you.